When it comes to financial stability, a good credit score is an important aspect to consider. This is because banks, businesses, and landlords look at your credit score when considering you for loans, mortgages, rental agreements, and even insurance packages. When applying for a job, employers might even look at your credit score as part of their overall consideration of your eligibility for the position. Because of these reasons, you need to make sure that you'll maintain a high credit score. But how? The answer is a lot more simpler than you think, and you are just a few minutes from finding that out. Welcome to Financial Pay Dirt, where you'll learn about the best and most interesting topics on YouTube. In this video, we are looking at how you can maintain a good credit score. Now first, what is a good credit score? It is important to take note that credit scores may vary from 0 to 850. If you are new in the US, you'll be at the bottom because you have no credit history. A low credit score is a bad credit score. Here is how credit scores are categorized. Bad from 300 to 629. Fair from 630 to 689. Good from 690 to 719. And excellent from 720 to 850. Typically, financial institutions and landlords prefer that candidates have good or excellent credit scores. Majority of the population have credit scores that fall between 600 and 750. So how are credit scores calculated? Okay guys, there are two main credit scoring models, FICO and VantageScore. Lenders have a clear preference for FICO, as it is the model used in over 90% of US lending decisions. Both of these models have scores ranging from 300 to 850, with the payment history being the most influential factor in determining your score. However, they differ in exactly how they weight and rank several other factors. Let us break it down for you according to the key factors that are considered and their weight in the computation using the FICO score model. Number 1. A payment history with 35%. This determines whether you've paid past credit accounts on time. Number 2. The amounts owed with 30%. This is the total amount of credit and loans you're using compared to your total credit limit, also known as your utilization rate. And number 3, length of credit history with 15%. This is the length of time you've had credit. Number 4, new credit with 10%, or how often you apply for and open new accounts. And lastly, number 5, a credit mix with 10%, or the variety of credit products you have, including credit cards, installment loans, finance company accounts, mortgage loans, and more. And what doesn't have an impact on your credit score? There are a lot of common misconceptions about what can affect your credit score. An example of this is wealth. This is not true. Income, balances in retirement accounts, equity in your home, net worth, basically anything that defines how much money you have or how much you're worth are not considered by your credit scores. Other factors that don't affect your credit scores include race, religion, nationality, gender, your marital status, your age, political affiliations, your education, your occupations, your job title, your employer, your employment history, and where you live or your total assets. How does your credit score affect the credit cards you qualify for? Well, obviously, the higher your credit score, the more cards you can qualify for. If you have an excellent credit score, you'll have better qualification odds for a premium credit card. An example of this is the Chase Sapphire Reserve, one of CNBC Select's top recommended travel rewards card, only available for people with high credit score. Okay, let's say you had the chance to get a premium credit card. What happens if you don't pay off your credit card debt, and how does this affect your credit score? The amount of debt you have is one of the biggest factors that go into your credit score, as what we've shown earlier in this video. The higher your credit card balances are relative to your credit limit, the more it hurts your credit score. Maxed out and over the limit card balances are the worst of all. Carrying a lot of debt, especially high credit card debt, can really hurt your credit score and your ability to get approved for new credit cards, loans, and an increased credit limit. Even if your debt to income ratio is low, if your debt hurts your credit score, you could still be denied. Yikes. Here is the most awaited question. How can you keep a high credit score? You should handle your debts well. Quickly paying off your balances helps raise your credit score because you are lowering your credit utilization. If your debt is too much to handle, your credit score could suffer. For example, if you miss payments because you can't afford your debt, you'll lose credit score points. Don't even think of choosing to file for bankruptcy to deal with your debt, as this will result in credit score damage from which it takes several months, even years, to recover. Credit counseling and debt consolidation don't directly affect your credit score, but debt consolidation can harm your credit score. You could be penalized for opening up a new account, an action that lowers your average credit age. The age of credit is 15% of your credit score. While some debt solutions can hurt your credit score, they may still be worth considering. Hey, you can rebuild your credit score over time. And also, being debt-free is the best for your overall financial health. That's it, guys. You just found out everything you need to know about maintaining a good credit score. Did you learn something new? Let us know below. If you liked the video, let us know by dropping a comment and hitting the like and subscribe button. And do share it as well. Also turn on your bell notification so you don't miss out on our future videos. See you next time.